let's start here. Let's have a look at the agenda first, and then we'll dig into the topic deeper afterwards. So the overview, first of all, we want to give an overview once again about or over major currency pairs. Some of you probably have heard or listened to have watched the recording here within this Trading Spotlight series from a webinar we had 1 month ago, 2 months ago. I'm not very sure, but the topic here was some basics when it came to FX trading, and their major currency pairs played already a role. And in fact, and this is what we want to refresh today again, and then take this as a fundament to have a look then at volatility, typical behaviors of each currency pair, especially the major currency pairs in this case, and then also answer the question, which in this case ones, but currency pairs, which major currency pairs especially are most suited to different traders, and based on what should you make the decision whether to trade this or that currency pair, in fact. So this is today's agenda. Before we start here, let's give a short overview about the ones who are giving you the input here. So this is me. All details around my person will be found in the chat box, so please feel free to check out the chat box here if you're watching this live now, or if you're watching the recording, feel free to check out the description box on the YouTube channel. There you have all information in an interview Admiral and I did together in July before we launched this Trading Spotlight series. Yeah, Admiral Markets is the company, the broker who makes all this possible here, this Trading Spotlight series, delivering this content here for the audience for free. A global player in the FX and CFD business, one of the, I think it's fair to say, one of the biggest brokers out there, at least when it comes to FX and CFD trading. Also, when it comes to the offices around the globe, 20 countries and more, fully regulated by the FCA, but also in Australia, for example, by the ASIC. In Europe, here's the topic Brexit and everything, CISEC, and all this. No one really knows what will happen around the Brexit. Probably also something which could trigger volatility, by the way, something we want to look at. What probably is interesting in regards to my person is that I'm located in Germany, and Admiral has also an office here in Berlin in Germany, the city I'm also located in. And what I can say is, and that's one of the main reasons you definitely should have a deeper look at Admiral. If you're not familiar with their offering right now, feel free to reach out to the website for further details on their DAX offering. So in Germany, we refer to Admiral as the DAX expert, so probably the most competitive offering in the DAX universe. I don't know any broker who has a better offering here, and that's probably one of the main reasons why you should definitely look out for Admiral. But here also, we today want to look in the FX space. Also, when looking especially at their so-called prime offering, you will find out that the FX offering they have here and the spreads they deliver, and obviously the liquidity providers they're working together with to get the liquidity for you as the client, is not just highly competitive, but probably also one of the most attractive offerings out there when it comes to the width of the spread. So there's several data which shows that Admiral Prime especially is offering one of the most competitive, probably the most competitive offering right here, right now. And so also definitely worth a look. And so that's it. Let's now focus on major currency pairs, and let's focus on today's topic when it comes to volatility here in trading. So first of all, the most traded currency pairs, that's something we mentioned already during this basic webinar a month ago. The most traded currency pairs, also in terms of liquidity here in the world, are called majors. And what I can say is that they involve currencies like the euro, JPY, Japanese yen, pound sterling, Australian dollar, Canadian dollar, and the Swiss franc, which are then traded against the US dollar. Some of you probably will also have heard about the term G10, G10 currencies. These G10 currencies also include some so-called Scandies. They include the Swedish krona, and also is it the Norwegian krona? I think so. I think it's Norway, but definitely it also takes Scandis here, so currencies from the Scandinavian hemisphere into this. This G10 basket. We want to focus on these currencies here, and I've created here a table which gives you not only those currencies we want also to focus today on, but also the lingo which is usually used among FX traders when it comes to trading EURUSD, for example. So it's not it's very common to say we're trading the euro here or a euro dollar, for example. The problem with this is, especially when it comes to euro USD, if you're a professional trader, euro dollar is not really the perfect explanation when it comes to trading euro USD, because euro dollar futures is not the euro FX future, but euro dollar is in fact focusing here on a what's the word for this? It's a treasury. I'm not sure whether we can say that, but it's like it's giving an overview of the current liquidity, where yield levels, which is delivered. In fact, when it comes to deposits which are not located in the US. In fact, it's one of the most traded futures in the world, with the debt which is way above, for example, equity markets. So sometimes this is giving some irritations, but in general, when we refer to euro, especially euro dollar, we are usually referring to euro USD in this case. Dollar JPY is usually dollar yen. Very simple. GBP USD is referred to as cable. There's a very interesting story behind this. So it's probably just details around this, but still, it's not bad to know it. So there was, this is referring to the first connection between the United Kingdom and the US, and there was a cable across the Atlantic which connected both islands, and so that's why we refer to GBP USD also not only to pound sterling dollar or sterling dollar, but also to as cable. In fact, then we have dollar Swiss franc. Short, it's the Swissy. Dollar CAD is the loonie, in fact. So I have to admit that every time I talk about Canadian dollar, I usually refer to the loonie, mainly focusing on dollar CAD, in fact. But if you have seen the recent developments around the rate decision, for example. So today is the 24th of January, 2020. 2 days ago, that was on the 22nd, there was the BOC rate decision. So Bank of Canada gave their outlook for the monetary policy path they will follow. They kept rates unchanged, but still there was lots of volatility in Canadian dollar, since chances spiked higher, or the likelihood of the Bank of Canada cutting rates and within the next months increased, in fact. And there was also a quite a dovish stance, which was used from the current BOC Governor Polis. And so why do I say that? It's important because I wrote a technical piece. You can find it on the website from atmarmarkets.com within the technical analysis section, in fact. And there I was writing the lines, and then I started to talk about the loonie, and I started to talk about the broad weakness, which... Oh, what just happened? Am I still here? Hello, hello? Yes, I'm still there, because there's something which just happened. Can you still see me? The webcam also. So the reason I asked, by the way, is I probably... Okay, perfect. So everything's still fine, yes? Okay. Well, the reason I ask is because I had some issues with my internet connection in the morning. So right now everything should be stable, and also the upload and download is back to what I should expect here from my provider. Still, I'm very sensitive here, so I'm a little scared that something could break down or something. But everything seems to be fine. Fair. Oh, great. That's great. So let's come back to the loonie story. So I refer to Canadian dollar here as a currency which went or saw some pressure, selling pressure, not only against the US dollar, but also against the JPY, for example, especially. And so I referred to Loonie, and then I just thought, well, probably it's not such a good idea to refer to Loonie because dollar CAD is usually what you refer to as Loonie. And so I rewrote it and I mentioned then the Canadian dollar. But sometimes I refer to Loonie, and if I talk about the Loonie, it wouldn't come as such a big surprise afterwards to find out that I'm talking about a Canadian dollar also against other currencies here. Yeah, then we have the Aussie and the Kiwi. So Aussie dollar, sure, Australian dollar against the US dollar, and then the Kiwi dollar, New Zealand dollar against the Kiwi. Yeah, and that's it. In fact, or the table here on the major currency pairs. And now we want to jump right straight to a very crucial concept when it comes to trading, in fact, and one which has come to the attention of traders, especially FX traders, over the last, let's say weeks, months, I'd say. The fact that volatility dropped enormously here when it especially came to major currency pairs like Euro USD, for example. So it was for especially breakout traders in Euro USD, I think it was devastating. It was just really annoying, in fact. And so volatility obviously plays a major role when it comes to trading in general, especially then when it comes to Forex trading and such deep and liquid markets as FX markets tend to be. So what is volatility? Volatility refers to the variation in the trading price over time. The broader the scope of the price variation, the higher the volatility is considered to be. And then being aware, it's obvious, being aware of a security's volatility is important for every trader, as different levels of volatility are better suited to certain strategies and psychologies. So just give an idea right here, that means, for example, what you could find out, and we will show this with an external website. I will provide you also with a link here. There we can say, for example, that currency pairs, especially if you look at it from a longer time perspective, volatility is quite low in currency pairs like Euro GBP. So Euro GBP tends to be quite stable. Sure, after the Brexit and then also over the last years then with several developments around the Brexit, political uncertainties and everything, there has certainly be some bigger swings from time to time, but all in all we can say currency pairs like Euro GBP, for example, over time present themselves quite volatile. Why is this necessary to know? Because when, for example, I favor breakout trading strategies, like some of you probably have heard about the Asia breakout system or strategy, there we look at a time span between or over the Asian market hours. For example, let's say from 2 a.m. German time, in this case, in the morning, till, let's say, 9 a.m. or 10 a.m., whatever, in the morning. So then you have a time span which also covers some part of the spot market opening of European assets, but most of it covers the Asian trading hours. And usually what you can see, especially in currency pairs which do not include the Japanese yen in this case, for example, currency pairs like GBP USD, but also Euro USD, but also currency pair like Euro GBP, they see low volatility during this time span during the Asian trading hours, given the fact that certainly that there's no big announcement, political developments, earthquakes or whatever. So everything stays, let's say, calm, and there's no big volatility hitting the markets during that time. So what you can then see is that the market tends to trade within a range, and there's a high and the low, and usually there's strategies which are aiming to trade breakouts of this range, with then the tendency, or to try to capitalize on the fact that the market tends to build momentum over the day then, in the direction of the breakout, for example. So when now knowing that you have a currency pair like Euro GBP, for example, with low volatility, and continuing not only to trade within this range during Asian market hours, but also during the European trading hours, and then also with the opening of US market openings in the afternoon, that the market naturally tends to trade sideways and very volatile, or that there's not strong breakouts in one or the other direction. You can be sure to some extent that if you're trading breakout strategies, a currency pair like Euro GBP, for example, does not suit your trading strategy well, and so you should skip this currency pair. Instead, use currency pairs which are more volatile, and thus favor breakout strategies in this case. So the question here comes, volatility is good to trade. Let's put it with a metaphor, okay? So we can consider, as traders, we consider volatility as our air to breathe. That's how you could put it. So if there's no volatility, there's usually no trading. Many hedge funds, you probably have followed also the developments in the whole financial industry. Many hedge funds have suffered enormously, not only due to the fact that there was lots of billions and trillions of USD pouring into the hedge fund industry over the years, and especially before the great financial crisis hit then in 2007, 2008, and that this usually resulted in a diminishing edge they could capitalize on, but also hedge funds depend heavily on volatility, and the lower the volatility, the worse, or the more unlikely it is that you can start to capitalize on certain moves in one or the other direction. So without this air they need to breathe, we need to breathe, we as traders, hedge funds also need, asset managers and all need to breathe. It is very, very difficult to make money in the markets, especially to generate so-called alpha in this case. That's definitely something where we can already understand why volatility, and knowing the volatility in certain currency pairs is so important to know, especially when it comes to the question, what are the best currencies to trade? So if you know yourself, and based on that you have a certain trading style you favor, well then certainly you have already a good idea which currency pairs you should take into account here and probably consider trading, and which you should probably skip. So FX volatility is often connected to economic news releases. For example, commodity-dependent currencies tend to be more volatile. Aussie, NZD, CAD. We will see that this is obviously a text which was written before the current developments, especially when looking at NZD, for example. So volatility is really, really low right now, also in those commodity-dependent currencies. Then currencies from so-called service-based economies, or currency pairs with high interest rate differentials. Especially the latter part is something to realize here. So if you want to understand why volatility currently is dropping that enormously, and therefore I've prepared, let me just look here. So this is what we want to look at a little later on. But first of all, let's have a look here at this chart first, and then we go to the next slide, and then also to this volatility calculator. So what I have here is a chart from Bloomberg, and it covers the JP Morgan Global FX Volatility Index. So they have created, JP Morgan has created an index which covers FX volatility and spreads over all FX currency pairs, so all currency pairs, and look at it. And so what you can see here is that there have been periods, when looking back the last 30 years in this case, so the chart goes back to the 1990s here, in fact, when looking at the spike higher, that was the time when there was this huge unwind in especially carry trades back then, when the big financial crisis hit here, and there was this huge risk off hitting the market, massive deleveraging taking place. So during the time here, 2005 to 2007 especially, so 2004 probably, there you can see there was this drop in volatility. And this has mainly to do with the fact that the market was tending to buy risk on / high yielding currencies, and they finance these high yield trades by shorting JPY, for example. So a 0% interest rate currency. So now what you get to see is, if the market looks for yield, they sell JPY, They sell also other low yield currencies like Swiss franc, for example. In the current environment, euro. That wasn't the case here back then. We had yields around 4.5%. In the euro alone, there was also a time when the US dollar and the interest rate here from the Fed was set at over 5%. So what happened here was that they sold JPY and then bought, for the money they received for selling those JPY, they bought the high yield currencies. So when then the tide turned and the markets got hit by a risk-off mood, they rushed back from their trades they had here in low yields, they had in high yield currencies, and they rushed back into the low yield currency. This is also usually the reason why you see during times of risk off hitting the markets, why you usually see JPY spiking higher, why the JPY profits from that. It's not because the JPY is a classic safe haven, but it's based on the fact that it's a classic carry trade currency, or a vehicle for carry trades in this case. So selling low yield currencies, buying high yield currencies. And if this reverses, then you get usually to see also here huge spikes in volatility higher. So then volatility dropped again after markets calmed down, and especially when low yields became, let's call it, state of the art, or what you could have expected, or what you could see all around the globe, with especially the global central banks going for lower interest rates. As in fact, there is no such thing as a big yield differential. So there's no big difference now between buying, let's say, a US dollar and buying euro. This is very difficult because we have still a high yield currency with the US dollar still yielding 1.75%, or in case of 10-year bonds, for example, we have a yield of something like 1.8 or something right now, while, for example, German bonds are selling at negative interest rates. So, which means there's a yield differential of something between 2 to 2.5%. But all in all, there's not such a big difference as it used to be, especially before the great financial crisis hit. And once those yield differentials decrease and diminish, and there's no such thing as a carry trade or attractiveness to carry trades anymore, that's usually the time when also volatility in FX markets gets hit and drops like a stone in this case. So right now we are here at all-time lows when it comes to volatility, a region which was also seen in 2014, and this is a perfect sign. And probably also we haven't yet seen the bottom here, but we should expect volatility to continue to drop, which makes it very, very difficult, for example, in the current environment to profit from, for example, breakout strategies, which need a certain level of volatility. And that's probably even more important now to cherry pick the currency pairs you take into account here. So what do I mean with cherry picking? Now let's go back here to the slides. Cherry picking means that you need to make sure that you understand the concept of volatility and then find ways, that's not so good, find ways to easily compare currencies with each other, currency pairs with each other, and see which currencies have a certain level of volatility you need to continue to profitably trade a strategy like the breakout strategy, for example. So such a volatility calculator here can be found on this website. So let me just share this link with you. Oh, by the way, I can, one second. Let me just see whether I can copy and paste this from here. Let's try this. So FX vol calculator. I also will share this, by the way, with the or within the chat box. So if you see this right now recorded on the YouTube channel from Atma Markets, if you like it, please leave a thumb up here. And not just that, but also scroll down a little in the description box. You will find this calculator here. We will go through this in a few seconds. So first of all, let's go here through these numbers and probably hurry up here a little. Let's do it that way. So What do we have here? Very simple. It's an example of volatility over the last 10 weeks, in fact. And with this calculator, you can easily see this. It's calculated for you and your trading. So you just need to go to the website and then look at the currency pairs which suit a certain level. For example, like we need a minimum volatility of something like 80 to 100 pips or something for the strategy to continue or to have a higher likelihood of being profitable, let's say. So I only focus on the currency pairs which have minimum volatility over the last 10 weeks, for example, of 80 pips and above that. So, and now let's go to the website. It's probably better and more interesting to look at this here. So if you go to the website, one second, by the way, I just have to. Okay, so what can you do here? So it's self-explaining, in fact. So you can say, let's have a look here at the last 10 weeks. And please calculate over the last 10 weeks volatility in all these currency pairs which are listed here. And I think this gets the job done in most of the cases. One second, please. Yeah, what can you see here? Well, you can already see here the number of pips. And for example, US dollar, Canadian, Australian, I'm sorry, Aussie against the Canadian dollar. And over the last 10 weeks, the average volatility, let's call it, has been 55 pips. So what means here is they look at the daily candle in this case, and then they look at how big the volatility has been over this time span, in fact, here. So there's also an idea. This is also very, very nice. When looking at the Euro USD, for example, you have the daily volatility in pips, and then they average it down. The time frame here is for 1 month. You can also go as high as 6 months, for example. And now the reason why Euro USD is displayed here is because there is the dot, which means if I now, for example, say, let's have a look at GBP JPY, then you can see it switches to GBP JPY. Okay, so and now you have obviously the chance to see the volatility of each currency pair here and what happened. So volatility here, for example, increased over the last 6 months to as high as 150 pips in GBP JPY. So this is usually a currency pair, by the way, which is also being. You have to be quite careful about it, trading it. That's true. GBP JPY is probably a bad example. We could also see something like GBP Klatt, for example, here. We will also dig deeper into this here. But what you can see is that these currency crosses, especially those who somehow have kind of a yield differential still available, so low yield currency like JPY and GBP, but also Australian dollar and Canadian dollar, that these currency pairs here, so these are the commodity trading pairs, that they tend to be more volatile, and not only more volatile, but it's also very, very interesting when it comes here to, for example, order execution, slippage, and there's also the question now around the swaps. No, the swaps are not. You can't look up the swap rates here, but these can be found on the website from Upmer Market. So feel free to reach out there. They have plenty of tools available on their website too here, in fact. But let's come back to volatility in this case. So you can now easily see if you for example say I need minimum 80 pips range or 80 pips daily, let's call it a daily range and a volatility of a certain amount here to trade my strategy still profitably. Well, you can say, okay, then these currency come into play here, all with 3 figures in this case, so 100 pips and more, but also probably all above 80, for example. And then you filter these out, and at the end you go down and say, okay, and now I look which of these are major currency pairs. So for example, if you say GBP JPY, GBP Klatt, GBP Australian dollar, and also GBP NZD, and then we have also, where we have it here, GBP USD 96. You have these currency pairs. Well, which of these is a major pair? It's only GBP USD, and that's why we should focus then on GBP USD. I will also present to you a reason why focusing on major pairs makes most sense. But In fact, I mean, I think this is in fact self-explaining. So there's no real reason now to dig deeper into this concept here, because it's a perfect way to illustrate volatility in certain currency pairs. Also here, for example, let's have a look at Euro GBP, for example. It's interesting to see, in fact, that volatility here has been elevated, let's say, so with a range of 56, 57 pips, for example. I just told you that Euro GBP usually is known to be not a very volatile currency pair. Let's have a look here at the last 12 months. What get we, yeah. So especially during times here, during summer months, volatility really collapses, in fact. So it retraces then a little. Probably, let's see what will happen, especially after the 31st of January, with the Brexit being done by then. But in general, we can say that, for example, let's take a more extreme example. Let's have a look here at Euro Swiss franc, right now at 45. And even this is... yeah, you can see this is more common, let's say, to get this volatility around 40 to 45 pips, something which is probably here for you not interesting then when you look at it from a strategy perspective, trading breakout strategies, but probably more interesting when it comes to range trading, for example, range trading approaches in this case. So let's go back to the slides. And let's now have a look at the question, which are then the best Forex pairs for different traders. So in general, I already said it, focus on the most liquid ones like Euro USD, GBP USD, USD, JPY. I skipped now Australian dollar USD, I skipped NZD USD, dollar CAD. It's also true for them too. But I would always focus on the most liquid ones. This is especially true when it comes to the cost of trading. So we already had here now swaps mentioned. But it's also interesting from a so-called spread perspective, and the spread is one of the most important aspects when it comes to FX trading. That was one of the reasons why I mentioned upper markets in their prime offering right at the beginning. So it wasn't only meant to be a promotion, but it's also that it's just true. It's so important for traders. So I'm talking to you here as a trader in first place. Sure, Atma Markets needs to be mentioned because all of this here is just extraordinary. It's great, and it's just awesome to have a broker offering you as the client then to listen to professional traders here for free, but still. In first place, I talk to you as a trader, and I know how important cost in trading is, especially when it comes to spread. And the spread is the price you have to pay on top of the commission. And the smaller, the narrower the spread, the lower the cost of trading is. And especially if you document your trades well in the trading journal, something which we will also make a topic within the Trading Spotlight webinars in the next month, in February. I think it's 2 weeks, if I'm not mistaken. Probably it's in 2 weeks, probably in 3. But definitely, we will talk about how to optimize, how to use a trading journal, how to document your trades well, and then also to use the information here. And you will see once you do this, and probably you use an external platform, external software like FX Blue, for example, you will see that over time, the more trades you do, the more you have to pay. And at the end, it could be that the overall trading approach you're trading is profitable, but after deducting all costs, it's probably break even, or worse, you still lose money. But you're not losing because of the strategy being bad, but you lose because the cost of trading is too high, which means you have to then tackle this first, which means if you're listening now here and you say, I've never heard about Atma Markets before, I'm trading with XYZ broker, and my trading is not profitable. And I've seen this, that reducing the spread could be could result in more profitability, a high profitability in my trading. My current unprofitable trading approach would turn profitable only due to the cost of trading. Then I highly recommend taking a look at this here. And now let's come to the spread. And why I like to focus on these most liquid currency pairs. Now, let's assume we are looking at a currency pair like GBP CAD. Okay, it's not only that we have seen that the average trading range here is on average higher, but it's also true that the cost of trading is elevated. Let's say it's probably a nice way to put it. What do I mean by elevated? That means that there's due to the fact that we are here talking about the so-called minor currency pair. So a major or a currency pair which is not a major is most likely a minor or an exotic currency pair. And so it's a minor currency pair. Minor currency pairs usually have lower liquidity, which means higher chances of seeing slippage, so a worse price when it comes to execution your trade, but also they have a tendency to have a wider spread, which comes completely natural. So it's not because the spread widens because we are talking about GBP CAD. So in fact, to some extent, this is in fact true, but it has to do with the fact that we are here looking at two. We are looking at two major currency pairs. I'm sorry, that was no. I'm sorry, that not JPY, dollar CAD in this case. So what does it mean? Well, it's very simple. To get GBP CAD, you say, okay, USD here. It's getting crossed out here, so we only have GBP and CAD left, and so we have GBP CAD. But you pay a spread on GBP USD and you pay a spread on dollar CAD, so GBP CAD comes naturally with a higher price, or a higher spread in this case. Okay, so this is also something why I like to focus here on the most liquid currency pairs and the major currency pairs, because a wider spread, it doesn't necessarily mean that the trading approach itself becomes unprofitable, but it means at least that chances or that your edges decreases by the increasing cost of trading. And that's one of the reasons why I like to focus here on the most liquid currency pairs, on the major currency pairs, in fact, because I pay the spread. If you want to make it short, we could say we're paying the spread only once. And that's the reason why I'd like to focus here on the major currency pairs. Still, and this is now the other side of the coin, still the question is, what is your strategy? So if your strategy, for example, is a breakout approach that have higher volatility, in my case, for example, I favor to trade breakout strategies in Euro JPY, which has a higher volatility in Euro USD, but lower than GBP USD, and thus the currency pair suits very good in my breakout approach, but also my personality. So let me just go back here probably to this, to underline this statement. So we had Euro JBPY, so currently 67 here over the last 10 weeks. And then we look at Euro USD, there we have 48. So higher volatility, chances of a breakout approach potentially increase. Now let's have a look at dollar JPY here. Where do we have it? Dollar JPY. There we go, 46. So you see, the chances of my breakout approach, which I know suits my personality, increases with trading Euro JPY, and that's why I focus on it. On the other hand, I'd like to focus on Euro JPY because it still has lower volatility than, for example, GBP USD or especially GBP JPY here, with nearly twice as high when it comes to volatility over the last 10 weeks, which is, it's not that I can't cope with it, but I feel comfortable, let's say. I feel comfortable. I'm trading Euro JPY here. And so it becomes obvious how important it is not only to know who you are and what is your strategy, but also then have a look at if there's 3-4 currency pairs which probably suit this trading approach. Does it also suit your personality? If it does, then you have definitely a go for it in this case here. And yeah, so it's depending. It depends also mainly on the trading strategy. Still, with elevated volatility, and this is where then GBP CAD here in this case comes into play. Even though this is a bad example, because GBP USD itself has already a volatility which is probably suitable for breakout strategies in this case. But so the thing is that naturally you should definitely be a little careful here. Still, elevated volatility also means a higher chance of the strategy being profitable, even though you then have to look whether the wider spread, for example, diminishes this edge already, and it's probably better to focus on a major currency pair then. So yeah, and the last point then, when it comes to crosses, I mentioned this, so it's I just repeated here, especially commodity crosses, GBP CAD, GBP Australian dollar, since they can have substantially higher swings and are prone to slippage. This is something you should take into account: the wider spreads, the elevated costs of trading. If these costs overcome the advantage you have or you potentially gain with the currency showing on average a higher volatility, then you should probably skip it and again, focus on the major currency pairs. Yeah, and in fact, that's it. And I just saw that it's potentially perfect when it comes to timing here. So we have 2 minutes left. It's perfect for the summary then. Let's have a look at the points we discussed so far. So first of all, certainly there is no such thing as a best currency pair, okay? Traders can, thanks to a volatility calculator, thanks to know yourself, have a clear idea of who you are, and what suits your personality. You have a very good idea already, or you can already formulate a strategy, and then not only have the strategy, but also get an idea of which currency pair is potentially the best for you in this case, and your trading approach in combination. Then, based on the knowledge of your trading approach, strategy, and the needed or necessary volatility, again, breakout strategies, I refer to this for higher volatility. Don't get me wrong, it's not that I recommend trading breakouts. It means that I focus on breakout trading. But for example, you yourself find out I'm more a range trader. That means you probably look not for higher, but for lower volatility. So you can, in fact, change this and adapt to your personal needs in this case. And then you say, okay, I'm a range trader, we call this, and then I need lower volatility, and I need a probably tendency also that there's kind of a bouncing back within the strategy. So the trading really showing itself range bound for a quite extended period of time, while during times of a breakout happening through a news event, whatever, I sit on my hands then and wait till the market stabilizes at a new level then and starts to range again. And then I have my advantage back, the edge I need in my trading to make to make a profit, turn my strategy into a profit then, and then step back into the market. And so again, if you have this knowledge, first step to find your best currency pair, the best FX pair for your trading can be found. And in general, the main focus should be on the most liquid currency pairs like the majors, market depth. So what I mean with this is that the market does not tend to see such big slippage and strong moves, but it's more like there's more, it's not more structure, but it's like relaxed trading, let's call it this. You have tighter spreads, so lower costs in your trading. And so I made this point based on my personal feelings, on my personal needs. I have favorable, not only cheap, but also relaxed market conditions when looking at major currency pairs. Now the next webinar will take place on Monday. Don't forget to join us. It's Paul's turn then, and he will talk to you about how to intraday trade US indices, including how to identify good trading setups, how to use correlation to help good trading environments, and how to utilize simple tactics to build a trading plan. And oh, this is also perfect. I just thank you. So there was just a post in the chat box here on the reduction of spreads, by the way. So you can see that there's a lot of effort being done from the side of Admiral here to really help traders on their journey to become profitable traders, and this is one of the reasons. So it's not only marketing, and I mean at the end it sells really well, but from a trader perspective, believe me, the spread, the cost which come naturally with your trading, then it's definitely worth to give this a deeper look. But let's go back to Paul. So 27th of January 2020, 2 p.m. London time. Where check your inbox for the webinar link. This is especially true for all the guys here right now in the webinar. If you watch this on YouTube, then go to the website from Admiral Markets, admiralmarkets.com, and there look under the education tab, webinars for the trading spotlight, and there's the website, there's the contact details, and there is the risk disclaimer. And that's it from my end. So all the best. I wish you a nice weekend. Enjoy yourself. Talk to you again next week on Friday. Be here on Monday when Paul is there. I highly recommend listening to him too. And yeah, that's it from my end. So have a nice weekend. Talk to you soon. See you and bye-bye.